Jargon busting. Let's decode some mortgage terms for first-time home buyers. Hey, what's going on, everybody? It's Jeff Trevarthen, Jeff the Mortgage Pro. Thanks so much for watching today. I thought we'd take it really back to the very beginning and go over some basic mortgage terms for you so that you have an idea of what people are talking about when you are working on a mortgage loan, when you're working with a mortgage loan officer, when you're working with a real estate agent. Like, these are all common terms in our industry, but sometimes we all forget that these are things that you may not know about. So we're going to demystify and just uncover some of these basic terms and define what they mean for you today so you have an idea of what they are going forward, okay? So before we jump in, do me a huge favor. If you like these videos, go ahead and click the like button down below. And if you want to see these videos when they come out, please go ahead and click the subscribe button with a little bell next to it. And that'll give you updates as to when these videos come out for you. And I'd love to hear from you when these do come out, okay? All right, let's jump right in. Let's start with the first term. These are in alphabetical order, by the way, so that you have an idea, as we go through them, you can kind of figure out where they are in the video. So the first term is amortization. And then what does this mean? This is just the process of paying a loan off over time through regular payments. So amortization could mean how long the loan is also for. So for example, you may have heard of a 15-year fixed loan. That means the amortization is 15 years. Most commonly is the 30-year fixed mortgage. So that is going to be paid off over 30 years. So that's the amortization term. The second term is called the APR, and what it stands for is the annual percentage rate. So this is the total cost of a loan, usually as a percentage of the home's purchase price. So when you calculate the APR, you're going to take what's called the note rate. That's the rate that you're actually going to be paying interest on over the life of the loan. So when you're looking for interest rates, you're actually looking at the note rate. And the APR is taking those closing costs and helping finance those into the loan amount so that you can get your overall annual percentage rate on this. This is really common in the car industry. I'm sure that that's the rate that you probably see when you're looking at any type of documentation for your auto loans. It's also really common in the mortgage industry, but people definitely get confused between the APR and the actual note rate. So know that the APR is the financed rate, but the note rate is the one that you're actually paying interest on over the life of your loan, okay? The third term is the down payment. What the heck does that mean? So this is the initial payment that you make as a buyer, usually as a percentage of the home's purchase price. So you can buy a house with as little as 0 down for some types of loans, 3.5% down for other types of loans, 3% for some loans, 5% for some loans, and then so on and so forth, all the way up to 20% down minimum for some loans, and maybe even sometimes 25 and 30% down for some types of loans. All those different circumstances vary, but the down payment is how much money you're putting down. It's also, in the world of investing, called skin in the game. If you've ever heard of that before. So skin in the game means that you're putting in some of your money as equity, and then the loan or the bank is going to give you the loan, and that's going to be what their skin in the game is. So down payment is how much money you put towards the transaction as a buyer. The fourth term here is called equity. So equity is the value of ownership in the home, calculated as the current market value minus the outstanding mortgage balance. So for example, if you had a $500,000 property, it's worth $500,000, and you have a $250,000 mortgage on that $500,000 property, what's your equity? So we just take 500,000 minus 250,000. That gives us 250,000. So that's the equity that you have in the property. That's pretty cool. Okay. What happens typically over time as properties go up in value? Because that's tends to be what happens, what they do. Your equity goes up because you're going to be paying the mortgage balance down, but also because of appreciation, the property is going to get worth more and more over time. That means your equity gets bigger. So cool thing right there about that term, equity. What's fixed rate number 4? A fixed rate mortgage. That's number 5 here. So this is just a mortgage with a constant interest rate, and monthly payments do not change over the life of the loan. So here's one of the things that I always want to point out when we have a fixed rate mortgage, just about any other type of mortgage as well. So let's say you make a $2,000 monthly mortgage payment every month, and then one month you decide to pay $3,000. What's the mortgage payment going to be the next month? it's going to go back to $2,000. Okay, even though you pay more, you can never pay less than the original balance. If you pay more, that money goes to principal, and it helps you save money on interest over the life of the loan, but it doesn't change your payment. The payment's going to be exactly the same from the beginning all the way to the very end of the loan if you were to keep it for 30 years. So it could be $2,000 a month when you first start, and it's going to be $2,000 a month when you finish the loan in 30 years. Okay, so fixed rate mortgages, that is a constant interest rate and monthly payment over the life of the loan. Term number 6 is a credit score. Okay, so this is a numerical representation of a borrower's creditworthiness, and it's affecting the interest rate that we use to qualify you. So typically, the lower the credit, the higher the rates, the better the credit, the lower the rates, and they only go to a certain extent though. Some loans, credit isn't as big of a factor. For example, FHA loans, credit doesn't matter as much on those types of loans because those are for first-time home buyers and those are for people with lower down payments. But at the same time, you could use those as a tool as well if you really needed to. Okay. Number 7 is closing costs. Okay, this is a term where we define it as the fees and expenses, including appraisal fees, title insurance, and attorney fees incurred in the home buying process. So lots of different things can factor into the closing costs. This could include discount points. This could include taxes. So when you buy a property, just understand that there's not just your down payment that you have to pay for. There's closing costs as well. So you often will hear the term cash to close. That's your down payment plus the closing costs equals the cash to close. So closing costs are part of how much money you need to be able to consume or to make sure that the transaction closes. Okay. And I would say that that's something that buyers often underestimate. You can always take a look at, how much money you have for a down payment, but you always want to get a good estimate on how much closing costs are going to be, because they could be more or less depending on where you live, depending on if you're going to include your taxes and insurance in your closing costs. All those different things matter. Okay. Number 8 is pre-approval. Okay. This is the process of determining how much money you as a home buyer can qualify or borrow before you go out and look at homes. Okay. So when we do a pre-approval, we want to make sure that we look at all of your application, your income documentation, your asset documentation, your credit and your liabilities, just to make sure that we fit it within the guidelines so that you can go out and buy a home. The process of pre-approval helps give us a little bit more reassurance when you go out and make an offer that we're going to be able to get you a loan. Okay, nothing is 100% in lending, so it's always good to have this pre-approval because it's going to give us a really good chance that we're going to be able to close your transaction. Number 9, PMI, also called private mortgage insurance. So this is insurance that protects the lender in case of a borrower default, typically required on all loans when you have less than a 20% down payment. Now, there's special instances where you don't need to pay PMI, like a VA loan doesn't have PMI. It has other things that you have to pay for up front, but it doesn't have PMI on there. And then if you put more than 20% down, typically you don't have to have PMI on there. I would definitely take a look at what the PMI is going to be because it varies, right? There's different credit tiers, there's different down payment tiers that will affect how much mortgage insurance that you have to pay. So in some instances, it may be fine for you to pay mortgage insurance. It might even be like less than $100. So take a look at it, have your mortgage loan officer factor that in there, and see what that looks like for you. Okay. And then the last term that I want to define for you today is escrow. This is one that I had no idea about 20 years ago when I heard so many people talking about it. I'm like, what in the world is an escrow? So escrow is an account held by the lender to cover property taxes and insurance. So oftentimes when we have lower down payments, or maybe you want the option of having this, you'll have the lender set up an escrow account for you so that when your taxes and insurance payments come due, there's enough money in that account to pay it for you. So this typically results in a higher mortgage payment, which is okay because you don't have to make a lump sum payment sometimes. But a lot of people like to not have to pay for that as part of their mortgage payment. They would rather pay the lump sum, so they can do it that way too. In a lot of different instances, it's really just a personal preference of which one you prefer in most instances. But depending on your down payment and your credit worthiness and the type of loan, we may require you to have an escrow account. So just ask your loan officer or ask me if you're going to qualify with me to be able to figure that out. Okay. All right. Those are the 10 terms that I have for you guys today. I hope that helps you out. If you're a first-time home buyer, or if you're very new to this process, I'd love to be the one that helps you out. I'm going to put a calendar link down below. Let's chat about it. Let's talk for 15 minutes and figure out how we can help you get your first house this coming year. Okay. Any questions at all, please make sure you reach out to me, and thanks for watching the show. Talk to you soon. Bye.